Welcome, everyone. This is the ESOP Guy, and we are on a journey to an ESOP. Really appreciate you checking out our podcast today. I wanted to thank you for joining. If you are new to the podcast, I wanted to say welcome. If you have an interest in this podcast, let me explain it. It is a resource that we've put together that provides really just some good information on what employee stock ownership plans are all about. And this is our season 2. So we've done many episodes. You can find all the episodes on journeytoanesop.com. So today we are going to have the privilege of really going into a topic I think is going to be quite interesting. And we're going to talk about ESOPs as a capitalistic tool. And to do that, we're going to discuss that with Darren Gleeman, who's a partner at MBO Ventures. And just wanted to say thank you so much for joining us today on the podcast, Darren.
Oh, absolutely. It's a pleasure to be here.
Great. So let's get started. So really, I wanted to start with this question for you. Like, really your background is very interesting. And if you could give us kind of like a little snapshot of that and then just transition, like, how did you get into the ESOP world?
Okay. And first of all, by the way, you know how like you're the ESOP guy? In my world, I'm the ESOP guy. People always think, oh, the ESOP guy. And I guess just in the world that we're in, there's not many people doing ESOPs. So whoever is doing ESOP is the ESOP guy. But I like how you have that in the actual podcast name.
And I copyrighted it, by the way. Just recently got my copyright, but it's, because I figured why not?
Yeah, why not? I mean, that's fantastic. I didn't know you could copyright that. It wasn't usually a copyright and a trademark.
I think it's trademark. I don't know. I got my patent attorney to do it, and it wasn't very expensive, but so let's just go in kind of what you're doing. So you have a background in on Wall Street.
High frequency trading. Yeah, that's right. So I'll explain to my background. So back in 2000, I was working at a company, and myself and 2 other guys came up with a pattern in the stock market, like an honest to goodness, real pattern, not something where you see these books where you have the moving average, short-term moving average versus the high, whatever it is. It's a real pattern, meaning you can literally make money on it if you know the pattern that day. Like you can literally make money on it. So we started trading this pattern, and we were able to trade maybe 4, 5, 6, 7 stocks at a time, which is not that much stocks. So I had an idea. Well, what if we can go out and trade all 7,000 stocks and have the computer trade for you? Great idea. Went to the boss, and the boss is like, no, I get it. Love the idea, but there's just too much risk for this to take place. So we left the company and went to a much smaller company. And the much smaller company said, yeah, we'll allow you to use our broker's license. You can be a customer of ours. We're not hiring you. You can be a customer of ours, and we're not backing you, but we'll allow you to do it. You get a programmer, they'll work with our programmer. So we said, great. Turns out the best decision we ever made, that they were not backing us, because that forced us to use our own money. And so we launched our company. There was 3 partners. We hired a programmer, worked with their team, and I guess about November, right about a couple of months after 9/11, we launched. And when we launched, it did extremely well. Once you debugged, pretty quickly, to the tune of it was making a lot of money every single day, no losses ever. Meaning you have losses because you're trading, let's say, thousands of trades a day, you're losing, but overall, every single day, you're not losing any money. You are literally a casino. Well, what we didn't realize is that this pattern would generate tons of data. And the tons of data enables us to see more patterns, like a lot more patterns. And so we started trading those patterns. We need to hire more programmers. We started to need to hire more quantitative analysts to really go through the data. And so those individual patterns and programs, strategies, created more data. And that's how we started growing. And we grew pretty rapidly. It was an exciting time. We needed speed, because you're now competitors started coming in. You need a lot of speed, and that created a race to get the fastest computers. Again, we grew rapidly, and by 2018, we were doing over 0.5% of the entire U.S. market every single day.
That's crazy.
Which is it's a crazy amount of stock, and it's a crazy amount of stress, because you're putting your life on the line every day 100-fold, because you're allowed to borrow a lot of money to actually trade intraday. At that point, we were able to exit from the company, and I did okay. And so I'm like, what's my next move? My next move is going to be, like everyone else, private equity. But I realized pretty quickly that I didn't want to go into private equity because, number one, I know when you go into private equity, you know, what you got to do is you're buying up a bunch of companies and you got to fire a lot of people. And I didn't want to have to do that. No. It wasn't part of my nature. And we had already done that before. I knew what it was like. And then I found out about ESOPs. And here was ESOPs was something that was phenomenal, much better in my point of view than a private equity. And you're doing something not only for yourselves, but you're truly helping out the employees, the workers. And they made a ton of money, and you can also make a lot of money. So that's how I got into that world.
Awesome.
And so
yeah, I think that idea that where you meet all these different people with different backgrounds. I think yours is very unique, and transitioning from that type of environment, which I think, in general, it's about making money, to ESOPs, where I think it's more, for me at least, it's more of a holistic, like there's a lot more parts and pieces to it. Obviously, there is a financial aspect of this for the selling shareholder, for the advisors and all that, but there's a bigger picture to it. And so I think it's kind of interesting in your skill set coming into this. And you've been doing ESOP work for the last 2 years or 3 years?
Yeah, I guess it's been about two and a half years that I've been involved. I am the independent merchant bank for a much larger ESOP investment bank. And what I do is I go out and I try to find private companies and explain to them how ESOPs work. And if they are amenable to doing an ESOP, they will structure, this other company will structure, CSG Partners, they'll structure the ESOP. And there are times when I will also invest into the company. And that's really what I'm looking for, is to try to invest in these companies that are structured as ESOPs.
Awesome. So give us an example, like what's the typical size of a transaction that makes sense for you guys, and with what you're putting together and what you're trying to accomplish?
Yeah. So for us, the smallest possible ESOP that makes sense, it would be a floor of $2.5 million in net income, or what we call EBITDA, and 20 employees, and that would be the floor. Our sweet spot is more $5 million to $25 million in EBITDA.
Okay.
That's really what we're looking for.
Okay.
And there is no limit in terms of how high we'll go. But like I said, the floor is about 2.5, which is, in our world, it's a little low.
Sure, absolutely. And what kind of specifically, because a lot of our listeners are brand new to the ESOP world. So what's the value proposition you guys are putting on the table for someone when they're looking at me with understanding what ESOPs are, but also just saying, what do you guys do that really adds value?
Yeah, well, with an ESOP, number one, if you do a comparison, an ESOP is just another way for you as an owner to sell your company, right? Or you can sell a piece of your company. So you can sell your company to a strategic buyer, right? That's like a competitor, or you can sell it to a private equity firm. Those are usually the two methodologies. Well, the third methodology, which no one really knows about, is selling it to your employees via the ESOP. And when you go through head to head for each company, you realize that the ESOP is much better. For instance, just to take a very easy example, easy numbers, let's just say you have a $20 million manufacturing firm making $20 million a year, and it's valued at $100 million, right? Multiple of 5 times your EBITDA, it's $100 million. Well, when you sell to a private equity firm or strategic, you got to pay your capital gains tax, right? Can't get around that. And capital gains tax right now is about 30% on average throughout the country. It's going to go up to average about 40%. That's going to happen very soon, which means for a $100 million company, you got to pay $40 million in capital gains tax. That's huge. And it's crazy, but that's just the way it is. Well, when you sell your company to your employees via the ESOP for $100 million, that $40 million capital gains tax is deferred. And if you structure correctly, it's deferred forever. So that is a huge advantage that the business owner just does not know exists. Well, it does exist, and it's called the ESOP. Second thing, when you go out and you sell your company to a private equity firm, what are they going to do? Private equity firm, they're going to lever up the company. So in this example, right, it's $100 million. They're going to put $20 million down. They're going to get a loan for 60 million, and they're going to have the owner do a $20 million earnout. That equals 100 million bucks.
Mm-hmm.
Well, an earnout, by the way, for your listeners, that means that you don't get paid right away. That means as long as the company reaches certain milestones, you then, as the owner, will get paid. And that's definitely not a guarantee that you're going to get that earnout payment. An ESOP is structured similarly, but it's all debt. Okay, there's no equity involved, there's no earnout. Well, okay, if it's all debt, why would someone want to do that? Why would they want to do that? And why would the owner want to do that? Well, number one, the debt that you have for an ESOP is subsidized by the government. And what does that mean? That means that, remember we said in this example is $100 million, right? When you take out a $100 million loan with an ESOP, right, you get to deduct the interest, but you also get to deduct the entire $100 million, which is huge, right? There's no other place you can actually do that and deduct the entire purchase price of the company. So that's a huge subsidy. So the way it works with an ESOP is, let's say ESOP, you go out and you borrow for the $100 million, you go out and you borrow $60 million from the bank. So you have $60 million from the bank, and then you as the owner would take a $40 million, what's called a seller note, which is an IOU from the company to the owner. Well, you as the owner, why would you want to do that? Why would you not want the money right up front? You might, but there's an advantage to taking this, what's called that IOU. The amount of return that you're going to get for that. The way we structure these deals, again, this is like more of a vanilla deal, but the way we structure it is you get the $60 million up front from the bank, which you're not going to be paying capital gains tax on that. And the $40 million that you're getting as that IOU, you'll get paid that in, let's say, year 3, 4, 5, you get paid that back. What you're going to get in return for that is an interest rate. Now, the interest that you should be getting should be about 13, 14%. That's what you should be getting. You as the owner should be getting on that money. Well, that's kind of harsh to run your company, 13, 14%. So we say this, instead of taking 13, 14%, you're going to get 3% on your money. That's very doable. Well, you're supposed to get 13. So what about the additional 10% per year that you're supposed to get? In lieu of that, what you're going to get is you're going to get the right to buy back a chunk of your company in the future at a predetermined low price, right? And so that right is called a warrant, and the predetermined price is called a strike price. So that means that in the future, you will always have the right to buy back, let's say 20% or 30% of your company at a very low price, which is a huge second bite at the apple in the future. Right. So when you put all of this together, right, day one, you get $60 million, not paying capital gains tax. Well, your private equity deal, day one, if they give you, let's say $80 million on day one, well, you got to pay 40% of that, which means that you have 60% that you're actually getting. That's $48 million on day one that you're getting from a private equity firm. With the ESOP, you get 60 million in this example, you're getting 60 million. Great. And then about 4 years later, you start getting paid down that, you start getting paid back your IOU, that seller note. So let's say that's year 4, you start getting paid back year 5, year 6. Now you're whole at $100 million and you're not paying capital gains tax on that. It's a huge advantage. And now the company, the last thing which we didn't tell you, is that the company, if you sell 100% of that company to an ESOP, the company runs completely tax-free. 0 federal tax, 0 state tax. It's a huge advantage paying no tax. This is why banks are willing to loan that $60 million at the beginning, right? They would not be willing to loan that if they didn't have this specific advantage, knowing that you can actually be a tax-free entity. It's huge. It's a huge advantage.
Right.
So again, as you walk through it, you make a lot more money with an ESOP as opposed to private equity.
Cool. No, I think that's a good overview, like a benefits of an ESOP. Let's jump into the topic on ESOP as a capitalistic tool. And I've talked a lot about in different podcasts, like the idea of wealth inequality in the country and different things like that. So when we think about capitalism itself, how do you bridge into that from what we were just talking about as far as capitalism in America and how ESOP's really an advantage for capitalism?
Yeah, because, if you think about it, with what we do right now in with an ESOP, most people look at it as okay, this is great for the workers. The workers deserve it. I don't know. I think it's great I know it's great for the workers, but the pitch of that they deserve it, that's not really capitalism. That goes more into communism, that they deserve it, they should be doing what they want. The way we've set this up is that the owners are incentivized significantly to give this amazing gift to the employees. Now, an employee by themselves, an average employee, they're making, I don't know, $15, $25, $30 an hour, is extremely, extremely difficult to build up any type of real net worth in your life, because you're living month to month, right? I mean, you're not making any money. So you do not have enough money to send your kids to college. You do not have enough money if some horrible event happens, some type of an accident. You do not have that money. It's just not there. An ESOP enables these workers to have a significantly greater net worth than if they were just working on their own or just working as workers. Now, again, back to the incentives. Without the incentives of an ESOP, it wouldn't happen. Now, I speak with business owners all the time. And the business owners I'm talking to, they love the idea of helping their owners, of helping their employees. They love it. But they're not doing it to help their employees. A small subset of people are helping it specifically, are doing it specifically to help their employees. A very small subset. It wouldn't be big enough. Most people are doing it because, wow, this is not a bad idea. This is actually a phenomenal idea. And I can also do what's phenomenal for my employees. That's almost like the cherry on top.
Right.
So,
because they're getting the tax benefits, that financially motivates them to jump into something that you're saying probably they wouldn't do if they didn't have that motivation.
They definitely wouldn't do it. So Russell Long, who actually was the one who put this together in the Senate back in the 1970s, right? And he was a people guy. He was for the people, really wanted to help the worker. He was very much for the worker. Well, he realized that there's no way that you're gonna be able to help the worker without actually giving very large incentives to an owner. Because why would I sell my company to the workers for a lower price, no incentives, for debt, when I can go and sell it out to a private equity firm for more money and just walk away from it? So he realized that. So he, along with Kelso, your listeners probably know who he is, came up with this plan. And the plan is a phenomenal plan. It's based on capitalism. The reason why I'm talking about it as capitalism versus socialism, because when this plan was initially created, right, and Russell Long spoke to this guy, Louis Kelso. And Louis Kelso was all about capitalism for the workers. Because especially at that time when he started coming up with this, is in the 1950s, there was a whole world of communists versus capitalists. How can we fight? How can we go back? How can we actually compete? How can they compete with us? And so Louis Kelso was like, look, the only way we can compete is if we can get these workers, right, to actually become owners. And so that's the beginning of this. So when it was actually started, it was started understanding that we need to help the workers, but in order to help the workers, we have to also incentivize the owners.
Right. Yep. No, and that's a great point. When I thought about this topic a little bit, I thought about the idea of, the main area of what are your resources in a company, right? And so you have labor and primarily capital. And so what does an ESOP do really? Ultimately, it frees up capital. It frees up capital by the taxes that you're not paying anymore as a business. So when you just think about the business itself, what that new capital does is it launches the business in a competitive advantage in the marketplace that really there is no other way to get there in our current economic and tax-based system. And so now if I pay my acquisition debt down with subsidized money from the government, and that's gone, now I've got all this new capital then to invest and grow. So I think that a combination of what happens to the ownership thinking with the employees, plus the resources of more capital, do now turn up the ability for that company to grow and create more jobs and to become more competitive not just in their geographic marketplace, but also as they expand, internationally. So those are kind of thoughts on, partly the way that I think the ESOP really is a tool for capitalism.
Yeah, incentives work.
Mm-hmm.
That's the bottom line, is that the incentives work. the owners of companies that do ESOPs do much better than private equity. That's the bottom line.
Yeah,
That's it.
That's a good thing to, I mean, Darren, most people don't think that way, honestly. As soon as you talk to clients, they're like, yeah, well, I'm going to sell it private equity. I'm going to get this big multiple. And they're comparing, they're immediately assuming something there. So I do think the mindset of the American business person right now is probably that they're going to make more money on private equity. I don't know if you agree with that or not, but
I think it's worse than that. I think the mindset is, I'm going to go private equity. That's the most amount of money. They don't even know that ESOPs exist. You know what I just mentioned to your listeners? Most owners don't know that. They don't know that the capital gains is going to be deferred, can be deferred forever. They don't know that the company can run tax-free. They don't know that they can have a second bite at the apple and get a piece of the company back in the future. They don't know any of these things. And when you put all of it together and you line it up, you're making a lot more money than private equity. No, my biggest issue in this arena is education.
mm-hmm.
You know, explaining to, not only it's not a business owner. If I speak to, and I speak to accountants and I speak to lawyers every day. And I always hear the same thing is like, oh yeah, I know about ESOPs. Okay. And then it's always hard for me to explain to them. Okay. And then I start talking to them about, well, obviously you know that when you sell to an ESOP, you're not going to be paying your capital gains tax if you're right. Oh yeah, I kind of forgot that. Well, yeah, and that if you sell 100%, you're not paying any federal or state tax. Oh, I didn't know that. And the government subsidizes the debt. Oh, I didn't know. So no one really knows it. They always hear like a certain bad case. Oh, I've heard that ESOPs, they're not as great. I heard there's issues with ESOPs. Okay, like what issues? Well, they're putting a lot of debt on the company. It's not good. Well, here's the alternative. Two companies, both in one company either. Your alternative is you sell to private equity or you sell to your ESOP. When you sell to private equity, well, what's going to happen? You're going to put debt on the books. When you sell to an ESOP, you're going to put debt in the books. The difference is that an ESOP actually is half as likely to go under than a private equity firm because of all the subsidies, which people don't know that. Everyone always likes to talk about the like the negatives, and it's just people just need to be re-educated.
People are afraid of what they don't understand. Number one, I think you do have this, and people, what they don't understand, they gravitate towards the negatives because then they don't have to deal with it. What I guess if you are, in a perfect world, this is why we're doing the podcast, to be honest with you. I mean, we want to educate people on the value of an ESOP, why it's applicable, at least considering it as an option. What are your ideas as far as the country in terms of educating people about ESOPs? Because there's a lot more to that, I think, that has to come into play for this to become a stronger, viable option for people to really understand it.
Oh, for the country. Well, right now in the country, I mean, you have Jared Bernstein, which is President Biden's economic advisor. And Jared is a huge proponent of ESOPs. He put a study out in 2020 that actually talked about ESOPs. And what he said is the biggest problem about ESOPs, awareness.
Mm-hmm.
People don't know that it exists. They don't know what it is. That was the number one problem. So yeah, it would be great if federally they could do something. I know on a state by state basis, they have these various organizations that are trying to help. But yeah, getting it out there is very difficult.
Yeah. I mean, I think that, I would just say, and this is just discussion. I mean, who knows what will happen in the next 5 to 10 years, but I don't know if there's any academic classes in college related to the ESOP. I mean, there's probably certain institutions that do teach it professionally. I mean, the CPA designation, I don't know has much in terms of the specialty related to what ESOPs are, but I do think, and I agree with you, that the professionals I talk to, whether they be other accounting firms, bankers, attorneys, the advisors themselves need an awareness of what ESOPs are, because they're only hurting their clients at the end of the day by not really taking it that seriously.
Well, they have literally no idea. It's interesting. Our community, our ESOP community, it's from a different cloth. For some reason, our ESOP community, when they go out and they explain ESOPs, it's much different than private equity. So private equity came to my company, right? And they wanted to buy my company. And so they came in, they said, look, your company could be worth X, it's going to be great. We're going to be able to expand. We're going to do all these great things for it. And it was interesting, and by the third, fourth meeting and you get to a letter of intent, you start getting more down into the details, but they got you excited, right? And the investment banking firm that you're working with, same thing, when it pitch you out.
Mm-hmm.
And I love it. And it gets you excited. In that industry, the private equity and investment banking industry, huge, $1 trillion in dry powder in private equity. The ESOP community, we come in and say, oh, you want to do an ESOP? Well, I don't know if you're going to make as much money, but it's really good for the employees. And, you could have problems. They don't ever tell you what is good. You automatically go into the problems of the ESOP. There's problems, everything.
Right. Of course. Right. Yeah. And I think sometimes the ESOP community then kind of steers towards like, these are the roadblocks, or, you've got ESOP governance, and you've got, controlling interest issues related to company and who's going to be.
And there's problems in everything.
Right. There's always problems.
Always problems.
From your perspective, there are real problems with ESOPs that have happened. And I would say, because of the Department of Labor, I mean, the difference between if I sell my company, and I'm just being the devil's advocate here. So I sell my company to private equity, I don't have to worry about the Department of Labor ever, because I'm not doing a retirement account for my employees at that point. I'm just getting my money and I'm leaving. So from that perspective, how would you address the concerns that a company would have related to, hey, this is a regulated transaction. If it blows up, and there are ESOP deals that have blown up, and we all know that. I'm talking from the perspective of a company business owner thinking, I don't want to deal with that. How would you address those kind of thoughts or questions or concerns?
Oh, absolutely. Every company that I've spoken to, and I know a lot of companies in my world, we all deal with litigation all the time. You're dealing with a regulator. You're always being regulated no matter what. And so the larger you are and the more money you make, the more issues you're going to have. And that's just bottom line. If you have a tiny little company, you'll have tiny little problems. But if you're going to be a company with like 10 million, 20 million EBITDA, you have issues.
Mm-hmm.
You think the end all be all is going public, right? Which I love the idea of an ESOP going public. That's totally feasible. And it's great. But the moment you go public, the moment you decide to go public, you're going to be hit with 8 lawsuits right away. Right away. So that's just the way it is. So that you're being regulated by the Department of Labor. Okay. That's just what it is. If you want to play in a bigger space, you're going to be regulated. Mm-hmm. And so that is the Department of Labor regulating you. Okay. So is it more of a flame out, a blowout? No, there's so many more flame outs with private equity. Private equity, you're dealing with the GPs and your limited partners, and you're dealing with the SEC. So when you get bought out by by a private equity, you're now regulated by the SEC because the private equity firm is, unless it's a tiny private equity firm. So now you're right in the middle of it. Mm-hmm. Private equity firm, right? They're regulated, right? So they're regulated by the SEC. You come in and do a purchase. Well, was it the correct purchase? They can come in and do anything they want to do. But now the regulation is SEC. Again, unless it's a smaller company or if it's a family office.
Right.
So everything is being regulated.
Right.
That's how I would look at it. So yeah, there are issues with the Department of Labor. And I think the amount of audit is what? It's like 1 or 2% of the companies now are audited by the DOL. So what I would always say to them is, look, you need to prepare, assume you're going to be audited by the DOL. You got to prepare for this. Mm-hmm. Yeah. Because that's just the way it is. That's how we handle that. You got to be prepared from day one.
Yeah. Well, and it goes back to the planning side. I mean, you do need to be prepared for the potential, and you need to be educated as the selling shareholder about your options and who and your advisors that you're choosing. And I've done this before, talked about this issue as well. You need to do your due diligence on your advisors, because you're putting, most selling shareholders maybe listen to this podcast, or maybe they've gone to a conference, but they're going to step into their first transaction as an ESOP really without they're not going to call themselves an expert. So there is an absolute reliance at that point on the advice that they're getting from people.
Oh, 1,000%. You want to go to the best possible advisor that you can. And it's just like anything else. If you're a manufacturing firm, right, and you're manufacturing pipes and you're manufacturing really good pipes, and your competitor is crappy pipes, you know what? The end user wants to go to the good pipes, the guy that has the really great pipes. Same thing with an ESOP. Mm-hmm. It's not an easy transaction. No. And you make one mistake and that can cost you a lot of money and cost you problems down the road. That's why with us, we've done over 325 ESOP transactions over the past 20 years, representing way over $20 billion enterprise value. We've structured over $7 billion in ESOP loans. We know what we're doing. Mm-hmm. There's a lot of shops out there that'll do, for instance, much smaller deals. And great, they focus on the smaller deals and they're amazing at the smaller deals. We just don't focus on that end because we know where we fit in.
Yeah, you know where your sweet spot. So what is the average deal size that you guys get into? Like, I know we talked about the small floor, but what would you say your average would be?
The average, I would say, let's say not the average, because you have some big ones that can bring up the average. Let's say the median.
The median, right.
The median size would be probably $75 to $100 million. Mm-hmm. Would be the median size.
Yeah, and I think the stratosphere, when you think about it, and I've thought about this a lot too over the last several years, the stratosphere of deal sizes is huge. Like that kind of size deal, the bigger ones, right? There's even bigger ones than that, of course. I've heard of $1 billion ESOP deals. We're talking about the structure of a company. When you get into the topic that we have right now is just talking about the pathway of not feeling like you're going to jump into something that's super risky, right? And you're really not doing that because you feel good about the advisors that you've chosen to steer you the right way. And of course, preparing yourself if you did have a DOL issue or whatever. But the complexity of a company that's $1 billion valuation or $100 million valuation or a $10 million valuation, what you find behind the curtain is you probably are going to have a different management structure, sophistication at that higher level versus the lower level. And so I think that's, in respect to those sophisticated levels, like you said, it's a small ESOP deal is probably not going to even have an issue at all, because it's just not going to be that complex. The higher you go, it's going to be more complex and you're going to be dealing with a lot more issues that might relate to, hey, I really do need to protect myself. So I think part of this whole idea is understanding where you fit in that equation in terms of the size of the deal with the sophisticated, leadership group that you have internally. And then how do you choose your external advisors is going to be a key element of that. But I want to make this point, and I think the biggest point here is that I don't believe the Department of Labor should rule your life and make you not choose the ESOP because you're concerned about having a DOL audit. And that's I think the bottom line.
Yeah, and I agree 100%. And the new Department of Labor Secretary, Marty Walsh, I think he's very friendly with labor. He wants what's best for the workers. He understands, how the process works, and I think he's going to be extremely good for ESOPs. He has to just figure it out. But I think it's going to be a huge renaissance in what's going on with the Department of Labor. I mean, there's definitely issues in the past, and hopefully, we're beyond that.
Yeah, I mean, we're talking about the government's role, and sometimes the issues are just because they get caught up with things. IRS does it all the time too, and so you just need to be prepared for that as an aspect. And I don't want to understate it like it's not a big deal, but I do want to make sure that it's clear that it's definitely not something that you should look at as an obstacle, and not really an obstacle, but look at it something as not makes your ESOP deal not really a certainty. That this is definitely something that everybody works through in terms of the normalcy of an ESOP deal.
Yeah, it's just part of doing business. Yeah. And that's it. You have that out there, but when you're a larger company and you have a lot of issues that you're always dealing with, and the bigger you get, like you said, it becomes more complex. We did a deal. It was a $500 million ESOP for a 1.2, $1.3 billion company. And it was extremely complex, a lot of issues, because it's a larger company. And we ended up structuring that. We did a high yield bond offering for that. It was phenomenal. It was great. Everyone did well. Employees now own a nice chunk of the company. The owners get a check for $500 million. They're not paying any capital gains tax on it.
Yeah.
It just really is, it's huge. But
Right.
yeah, did they have complex structures? Yes. And did we figure it out? Yes. And did we have other advisors working with us? Yes. It worked out well.
Right. You did it the right way. Right. Now it sounds, that's the whole point of it all. One thing too, I'll mention on the Department of Labor, most companies already have a 401k account or 401k set up. They're already dealing with the Department of Labor. And there's definitely a little more fiduciary relationship with the Department of Labor as an ESOP than a 401k, but there's still fiduciary with a 401k. So, most companies are already dealing with that. And so kind of just wanted to throw that out there as part of the understanding.
Oh yeah, absolutely. Anyone that has a 401k is dealing with the Department of Labor.
Exactly. So you're already in it and you maybe not even thinking about it. So, so let me kind of, as we start to close out this, let me ask you kind of what advice would you have for people that are thinking about ESOPs in terms of the next, couple of years and just, in terms of offering them, what you think they should be thinking about?
Well, if they're already thinking about an ESOP, then they've already crossed the threshold because now they are aware of it. And I believe that once you're already thinking about an ESOP, there's a very large likelihood that you're going to do it. So I would say, speak to some advisors, speak to a couple of advisors, and keep yourself educated.
Sure. Stay in.
And do not do it. Do not try to do it by yourself. Even if you're a smaller company, you're trying to save money. What they'll do is they'll go to just like one lawyer, like one guy shop, two guy shop, and they kind of know what it is. And they think, I'll figure it out. Just don't do that. Go to people like you, Philip, that know what you're doing, that's been doing it, and really, get the advice. Very important.
Yeah, I totally agree with that. And I think sometimes people want to use their own advisors, and we encourage them to be part of the transaction in the capacity that they can serve. Like, hey, review the documents from a legal perspective. The ESOP attorney is going to prepare the documents. Your ESOP, sell-side advisor is going to help, put the whole thing together. But everybody needs to play their respective role so that you can have a really good feeling at the end of the day that you've done it the right way. So I think those are good thoughts.
I was talking to a business owner very quickly. I was talking to a business owner that did an ESOP, and it was a decent sized ESOP. And she was talking to me and telling me she did it herself, with a smaller firm and her accountant. I'm like, okay, great. And then I started talking about the, warrants in the deal. And she's like, what's a warrant?
Oh man. Wow.
Yeah. And we started talking about it, and she had no idea, and they had no idea. They didn't structure it that way.
Yeah.
She just had no clue. And it's just because she didn't get an advisor.
Yeah. No, and she could have missed something huge, right? In the process of putting it together. And so that's why the podcast is important. I like the ESOP Association. I like the NCEO. I like these organizations. I think they're doing a great job. I think there needs to be, and there's more state organizations that we talked about. There needs to be more and more of that within the professional realm of those different associations, so that it's definitely creating more awareness.
I found that with the organizations, my issue, not an issue with the organization, my issue is that by the time you get to the organizations, you've already done it. You now are already in ESOP, as opposed to the 99% of the other companies that are not part of the organization and not looking at it.
Yeah.
How do we go out and educate them? I'm trying, with my LinkedIn, I'm trying to change my LinkedIn. I'm out there talking to my accounts. We're all playing our part, just trying to educate people.
Darren's LinkedIn is like the best ever. So if you do, get on LinkedIn, check out Darren's stuff. He's always got some really cool ESOP promotions and different things like that. I always say too, people that do ESOPs, tell your friends about it. Most business people will listen to their business associates. Like if you're doing like an Avistage group or a CEO group, roundtables, they're going to listen to those people more than anybody else. So I just say, if you know much about ESOPs, just share it with a friend, because I think that's it's going to have a lot more impact.
Absolutely. I agree with you 1,000% on that one.
Awesome. So I will just kind of close out with this saying thank you so much, Darren, for your time today. I think it was really fun to talk through what you're doing and what's going on in the ESOP world, why this is a great tool. And I appreciate your time.
I appreciate it also. Thank you, Philip. Thank you very much.
Great. So for those that are continuing to check out the podcast, thank you so much for listening today. We will see you on the next step on our journey to an ESOP.